Now I'm sure you're familiar about phase 2 heightened alert. Heightened alert. Now, I don't understand why we need to use such fanciful names, but what I do understand is that markets actually reacted adversely to the news. As of 1 p.m. when the news came out, markets tumbled crazily in a couple of hours, losing more than 2%, which I'll touch on in a quick while. Today I have 5 points to share with you, 5 points to note. Whether this market crash is an opportunity or not, let's discuss a bit further. And the first thing to note is this chart over here. What do you see? Of course, Singapore has lost 68 points on the index, which is more than 2%. But what I want you to focus is that everybody else is green, correct? Bursa, which is Malaysia, is green. Japan, which is Nikkei 225, Hang Seng, which is Hong Kong, and Dow Jones and Nasdaq, of course, is US. Everybody is green right there, while Singapore is red. That goes to show you that Singapore's market is very niche, very local. We did not impact adversely anybody else in the world. So we are indeed very small. We are indeed very focused on our own business outputs and stuff. But in a lot of ways also, that reinforces when you invest, you should have a globally diversified portfolio, because at some point Singapore outperforms, at some point global equities outperform. So build your portfolio with diversification. So that's something to note. And with that, let's move on to point number 2. What do you see in this chart over here? This is actually Riverstone Holdings, and that goes to show you that glove companies are rebounding significantly in their share price. I've actually plotted in blue Riverstone Holdings and yellow, which is UG Healthcare. UG Healthcare is a penny stock that seems to be very vibrant with traders, and both of them has actually shot up in the last 2 trading days. Riverstone Holdings, something I've covered before on this channel, getting more than 8%. And because I follow Riverstone Holdings so closely, I can share with you something to note if you're keen on getting on with glove companies. This is something mentioned in a Q&A with its CEO. And what I want to highlight for you over here is there's strong demand for its products, that's true, but the average selling price, ASP, for April, May, June 2021, second quarter, is roughly the same as the first quarter. What does that tell you? Global supply and demand has reached a balancing point, correct? And that goes to show that the revenue, the profits of Riverstone Holdings may be plateauing. Singapore's demand is not going to change the supply and demand that much. That's something to really quickly understand. And why it shot up by 8%, that goes to show that markets can be irrational. We don't demand so much gloves right off because of our new circuit breaker, or rather our new phase 2 measures. So that doesn't quite make sense. But what I want to suggest for you to consider as a critical point of thinking is that Singapore, we pride ourselves as having very good contact tracing, very good governance. Once there's a virus spread, we can't try to catch it before it spreads too big in the community. But what we see in Europe, and especially in US, is that there seems to be a lot of complacency, correct? Let me pull up this article for you to see. You realize that CDC has actually mentioned that people can go out and socialize already with no mask if they are fully vaccinated. Now, this new strain is so viral. When it gets there, which it probably is going to get there, you should expect that community is going to spread it crazily again. And vaccination, as what we understand now, without spreading fake information, is that it doesn't really prevent the spread. So that's something to note. If US and Europe goes in lockdown, you should expect global equities to be shaken up and glove demand to maybe have another leg upwards. Food for thought. And with that, let's move on to point number 3, which is oil price has not changed much, even with Singapore's new phase 2 measures. Now, this is a bit different as compared to start of last year, correct? In March and April, we saw oil price coming down tremendously because every country was going into its own circuit breaker or its own phase 2. They call it a lockdown in other countries. And global demand and industrial output suffered tremendously. That's why the charts tumbled from $60 per barrel all the way to $20 per barrel. It was really horrific if you're oil investors of that point of time. In fact, at that point of time, I do remember news that oil futures was actually negative for a contract or two. So that was really, really crazy. But as of now, oil has actually stabilized. It's suggesting that global industries are recovering. The mega trend still remains. So that's something to take note. What we are experiencing here in Singapore is not reflective of the rest of the world. Now, I've presented 3 key points. Hopefully you benefited. Smash a like. Inviting you to also subscribe because we'll be launching videos every week to touch on financial topics, retirement planning and stuff. And I have a point number 4 that I'm sure touches your heart in one way or another. Look at your neighborhood supermarkets. What do you see again? Mega crowds, correct? NTUC FairPrice, Siong, which is the key point that I'm discussing right now. Markets think that Siong would earn a lot of money in 2021. That's why after news broke out, Siong share price surged up by more than 10% again. Panic buying again. When people are buying toilet roll, you're buying stocks. So market does believe that Siong will earn a lot of money. But the interesting part is that Dairy Farm, which is owning Cold Storage and Giant, saw its share price decline, which is a different direction from Siong, correct? But of course, Dairy Farm's operations are more regional, for sure. But in that case, if you believe that demand for Singapore's groceries is going to go up, I think the only choice could be Siong, because the proximity to that play is just very much stronger. In that case, I've covered before Siong in the previous full tutorial. Look for the links below, and I'll also be covering in my private channel some updates on Siong. Because Siong is not a high key search, I probably won't be covering too deeply, but I have some interesting insights. And if you like that kind of topic, look for my private channel, click on the join. In that, I will actually explain more and give you more insights to things. But the point I'd like to draw back on is also, just a couple of weeks ago, analysts were suggesting to downgrade on Siong. This is actually CIMB's report. They believe that Siong has very few catalysts moving forward, and they are downgrading Siong to hold. And Siong themselves, they have actually communicated that they expect demand to taper post-pandemic. So actually, things change in a blink of an eye, correct? One moment, everybody's thinking, okay, supermarkets, the best days are over. And right now, everybody's thinking supermarkets are needed again for the next 1 or 2 months. So markets are always fickle. We don't know how things will turn next week. Let's just reinforce that point. And with that, let's move on to point number 5, which is something very sad, because I think we should all kiss travel bubbles goodbye already. You know, previously we had a plan to ink out a travel bubble with Hong Kong, correct? And what happened? They had community spread. That's why we closed that bubble up. And right now we're due to do something in May, and then we have community spread. So I think travel bubbles are kind of jinxed. I have a quick chart to show over here. Who do you see is the worst performer over in our Singapore index? SIA, correct? SIA lost more than 9% after surging up for so many months. It's finally corrected quite a bit. You know, on this channel I've actually shared before, SIA is not something I'm very keen on, simply because operationally there is a lot of risk still. There's a lot of debts, there's a lot of fixed expenses. My main preference, if it comes to hospitality, is actually in these two names that I'd like to box up for you also. Genting Singapore and SATS. All in all, hospitality has been ravaged because of this new news coming down aggressively. I do believe if you're looking for opportunities, hospitality could be one that could rebound if you're a very long-term investor. And these two names, Genting and SATS, I have a tutorial on, and especially for SATS, I do believe that they still remain a very good service-based company. They are still a very good dividend player. In that tutorial, I've also my baby coming out, so if you're keen, look for a tutorial. It explains a bit more on the opportunity with SATS. If it does come down another 10-20%, maybe it's good to consider it for part of your portfolio if you're willing to ride out the ups and downs, because eventually we will all overcome COVID-19. With that, I'll sign off. See you in the tutorial, and hopefully you benefited. Smash on like again. I'll see you there. Take care and goodbye.